Thank you for joining us on this webinar about life settlements. Very important BAM risk management and overall risk management topic. And what I'd like to do is introduce Eric Tenenbaum, the managing partner of Genesis Asset Advisors and one of our BAM risk management strategic partners. Eric?
Thank you very much, Aaron. Pleasure to be with you all today. My name is Eric Tenenbaum, as Aaron mentioned. I'm the managing partner for Genesis Asset Advisors in New York. And today we're going to present a webinar on life settlements, what every professional must know, the new tool for private clients, business entities, and nonprofits. By way of introduction, just a brief overview, we're going to talk a little bit about our firm and who we are, the life settlement industry, basic concepts in terms of how it evolved and what it's about, our role within the life settlement market, the fiduciary obligation that you as advisors have to your clients, compliance issues, and at the very end some case studies to see what the practical applications are. Genesis Asset Advisors is a leading life settlement brokerage which was established in 2007. What we do at our firm is we assist policy owners and advisors who represent them in terms of selling off unneeded or unaffordable life insurance policies which they no longer want to maintain. Much like other assets, when that asset is no longer wanted, there's an opportunity to sell the asset. And life insurance, which is today recognized as an asset, the same can be done with. Our firm works with life insurance agents, CPAs, wealth advisors, business owners, individuals, trustees, and we have a special platform specifically for the nonprofit community. We'll talk a little bit about all of these individuals a little bit later, but first I'd like to just give you a little bit of an introduction in terms of what the life settlement market is about. A life settlement is the sale of an existing life insurance policy for an amount higher than the cash surrender value and less than the death benefit. It allows a policy owner to come up with an exit strategy if the policy is not going to result in a claim post the death of an insured. The history of the life settlement industry goes back over 100 years. It resulted from a United States Supreme Court ruling in the case of Grigsby versus Russell. And in that case, the United States Supreme Court determined that a life insurance policy, much like any other asset, can be transferred for value. And it took about 90 years until the market actually evolved. That was due to it really being applicable to certain kinds of life insurance products. But by the late 80s, early 90s, and that most certainly in the last 10, 15 years, it really has picked up in terms of an alternative asset class. The most important thing to know about life settlements is why a person may settle a life insurance policy. Generally, that falls into one of four categories. Number one, a life insurance policy which is no longer affordable. Very often a policy that was taken out many years prior is just not affordable anymore. And until now, there was generally no other option in terms of your life insurance policy. You would either lapse it or you would do what was called a cash surrender. But that cash surrender was for a very nominal amount, and the life settlement industry created a market where someone could actually sell the policy for an amount that was a lot more attractive than surrendering it and, of course, letting it lapse. Like I mentioned, if a person can't afford a life insurance policy, or if they don't want a life insurance policy anymore, they don't need a life insurance policy anymore, this is a strategy, a wonderful strategy that can be used for clients and businesses and nonprofits or any other policy owner for that life insurance policy if it's no longer needed. We're going to talk about the other option, which is a term policy, which potentially would not be converted, and what the application is for term products. The types of policies that can be settled within the market are universal life insurance policies, whole life policies, and term policies. The types of people who, as we mentioned, can settle policies is really any kind of life insurance policy owner. It doesn't make a difference if it's individually owned, if a business owns it, if it's owned by a trust. Any policy can be settled as long as we have the consent of, obviously, the policy owner and the insured. Term policies are a tremendous opportunity within the market. It allows an owner of a term policy who would know in normal circumstances not convert the policy to permanent insurance, as usually the costs are too high or the insurance is just no longer needed. It was needed when the individual was younger, but now that the individual is older and their children or the family may be older and on their own, the term policy is no longer needed. Very often the term policy is allowed to just run its course and it doesn't get converted. The latest data that we have is that only approximately 1% of term policies ever pay out a claim in the United States. Most of that is due to the term policies never getting converted, and therefore there's never an opportunity other than it maturing while it's in the term period for a death claim to be paid. So it's a wonderful opportunity for term policies to be converted and then sold as a universal life policy. Various types of advisors and professionals need to be knowledgeable in our market, including attorneys, including CPAs, advisors, life insurance agents, and of course trustees, who are very much the gatekeepers when it comes to trusts such as ILETs, where many policies are owned in the United States. Moving on slightly, what Genesis does within our market. Our responsibility is to the policy owner and to procure an opportunity with various funds and providers within the secondary market. Practically speaking, our firm takes care of all underwriting, medical record retrieval, life expectancy studies, and utilizing that information. Our objective and our responsibility is to secure offers and to leverage offers with the various funds that we have. One of the ways that we do that is through the relationships and through the volume of business that we do, the knowledge base that we have with various types of policies, and generally having a very good understanding of which funds are looking for what types of policies and being able to make an offer actually work. So it's not always generally finding an offer, but it's actually getting an acceptable offer for a policy seller and finding a fund that can agree to pay that price. Part of our process is leveraging the various funds and providers against each other so we can come up with the best possible opportunity for a client. Generally, the underwriting process will include all work done behind the scenes. It is a non-invasive process. It requires the execution of a number of documents prior to the start of the process, and ultimately we will get back to a policy owner or to an advisor or both in terms of if an offer was procured and if we'll be able to move forward to a closing or not. The process of presenting an offer to a client involves post negotiating with a fund, multitude of funds coming back to a policy owner, ultimately getting acceptance on a policy and moving into a closing. The closing process is very, very similar to a real estate closing process, where we'll go through a documentation process, which generally can be turned around in as quick or in as lengthy period of time as the policy owner and advisor should choose. But ultimately, once the documents are executed and funds have been escrowed in a third-party escrow account, change forms will go to a carrier, and once those changes have been recognized by the carrier and we receive confirmation, the escrowed funds, the proceeds from the settlement, will be immediately sent to the policy seller. We'll talk a little bit just briefly about how value is determined within the market. Generally, what we intend to do is create arbitrage. Arbitrage is what determines value within the life settlement market. If an individual owns a standard or a preferred policy that had been issued some time ago, a number of years ago, and today they are not in that health category. Perhaps they are slightly rated. That creates an arbitrage within the market where we have a standard or preferred performing life insurance policy versus a current medical condition, which is rated or below where the policy was issued, and that creates arbitrage in the market, and that creates value within the secondary market. The process generally, which is very simple, is the policy owner will submit a policy for sale to our firm. We'll go through an underwriting process. Once that process is complete, the packaged policy will be presented to multiple buying sources, otherwise known as providers. Providers are entities that are permitted to effectuate a life settlement contract. Very often they are backed by specific funds focused within the life settlement community. Sometimes the funds are providers themselves and carry licensure in that applicable state. Once Genesis has procured offers, we will present those offers. Generally, for the most part, obviously, the highest offer is generally what is accepted by a policy seller. Very often, an offer will not be procured if we cannot create an arbitrage. But the point of the process is to allow a policy owner to be aware of whether or not their policy can be monetized today. Of course, we are very big proponents of keeping your life insurance. Generally, if you need it and you can afford it, you should keep it. But unfortunately, in the country, hundreds and hundreds of billions of dollars lapse every year, insuring individuals across the country, and a good percentage of that is on seniors. So if there is going to be a policy that will lapse or be surrendered or not converted, a policy owner and an advisor really owes it to themselves to have a life insurance policy evaluated and to really find out if the policy is valuable or not. Briefly, how the value is determined. We talked about arbitrage. There is generally a specific yield that a fund is looking for when investing in a life insurance policy. That is obviously based on a prospectus that is issued to investors. The age of the insured within the life settlement industry is very, very important. Generally, the sweet spot of the market are policies that insure individuals over the age of 70, although we have seen it work on individuals as young as 60 or 65. But generally, the market is a market that applies to insureds over the age of 70 and above. The amount of time the policy has to be enforced is generally 2 years and above. There are some states that require 4 years, and there are some states that require 5 years. The insurance industry, the life insurance industry, as many other industries, are regulated on a state-by-state basis. So depending on the type of policy and depending on the circumstances, the amount of time generally varies. But as a rule of thumb, it must be enforced for at least 2 years. The carrier rating is very important as well for an investor, and of course the type of policy. The fiduciary obligation that advisors have is very important when it comes to life settlements. An advisor who gives the advice to a client to let a policy go or to let it lapse, to surrender it, may be doing an injustice to a policy seller if they're unaware of the life settlement option. We've seen individuals who have come to us after a policy had lapsed or after an individual surrendered a policy, that were completely unaware of the life settlement market. And when we did do an evaluation, we did realize that they had left tremendous amounts of money on the table simply because the advisor and sometimes the client themselves were completely unaware of the market. So having a rudimentary understanding and being aware that this market exists is very, very important. Accountants, attorneys, wealth managers, really any kind of financial advisor that plays any role for a consumer should be knowledgeable within our industry. There are various states now, approximately 4 or 5 states, that require a life insurance carrier to give notice to a policy owner if an insurance policy is insuring an individual over the age of 60 or 65 in some scenarios of the life settlement option. So if somebody owns a policy and it's insuring someone over the age of 60 and the policy goes into grace, the carrier in certain states will be required to send a notice to the owner and make them aware of their life settlement option. An advisor needs to be aware of this option because they don't want to misguide a client and then possibly have the client get a notice from a life insurance carrier. So it's very, very important to be up to date in terms of the opportunities and in terms of the regulations that are in place, all in place for consumer protections. The fiduciary obligation, of course, is most important in knowing when it's applicable to a client. It is not applicable in every scenario. Many scenarios, the life settlement option will never come up, but again, it's a wonderful, wonderful tool, and advisors need to be knowledgeable not only about it, but really when it is applicable. Briefly to talk about compliance, the life settlement industry is currently regulated in approximately 40 states. Recently, in the past few days, the 41st state passed regulation. The other states are entertaining legislation currently, but as you can see, most of the country is regulated, heavily regulated. The regulations really apply to everything involved in the transaction, including forms, contracts, licensure for both providers, the buying entity, and brokers, the entity that a policy owner and advisor would retain to cover the market and leverage the value of a policy. The rescission period falls under compliance, and of course the industry for our firm and generally for most states is full transparency. There's commission disclosure as well as other disclosures that need to be put in place. So it is a very, very heavily regulated industry by the various state insurance and banking departments or that applicable or appropriate department within the specific state. Moving on to, as we mentioned, some of the carrier obligations, some of the state disclosures, compensation. All this is in place really to give a policy owner a comfort level in their knowledge that what they may be entertaining or what they may actually be engaging in is a very, very regulated industry, and that consumer protections are in place to obviously protect them from any nefarious behaviors. And the general consensus has always been that a well-educated consumer and advisor is really the best position to be in so they can make an educated decision. Briefly, in terms of case studies, every case evaluated for a life settlement transaction is a unique case. All policies do not generate an offer. That's a very, very important piece of the puzzle. They don't all generate an offer. However, there is no obligation in any way, shape, or form for having a policy evaluated, and being knowledgeable in terms of the monetary ability of the policy is what the industry is all about. Offers are generally cash offers. There are certain opportunities where retained death benefit offers are available, and that is a situation where an offer is presented in terms of retained death benefit. A fund or provider will take over the premium obligations on the policy, and when the policy matures, a portion of the death benefit would go to the beneficiary that has been directed by the seller, and the bulk of the death benefit will go to the fund that purchased the policy. In terms of case studies, there was an 85-year-old female recent case study, a policy face amount of $6.5 million with a zero cash surrender value. We procured for that client $860,000. In that case, it was a challenging case. The policy owner really had no interest in keeping the policy. They were having difficulty in the market in terms of finding an opportunity. They were led to us, and we were able to come up with a good solution for them. Case number 2, a 74-year-old male. There was a total of $3 million of insurance, $1 million and $2 million with cash surrender value as well as zero. These were term policies that they were going to let go, and they had no idea that there was a market. They eventually did become knowledgeable in the market, and we were able to sell these 2 term policies for $350. An 86-year-old female with a $500,000 policy that was sold for $150,000 to a client. And just moving on to the last case study, if we have it, as it's coming up here, a 72-year-old female with $3 million of a 70-year-old male, $3 million of insurance, again $1 million and a $2 million policy. This was an interesting scenario with a client that was not cash strapped and there was no real need to sell the policy. The coverage just simply was no longer needed. The client, the best option for this client was to accept a $900,000 amount of retained death benefit, where the fund continues to make the premium payments, and they will share in the death benefit when the policy matures. We thank you very much for giving us the time today. That really wraps up our brief presentation on life settlements, and for more information, you can visit us at genesisknows.com.
Thank you, Eric, for your time. We at BAM Risk Management are thrilled to have you as one of our strategic partners, you, Genesis Asset Advisors, Merritt Mamroth, as well as part of your team in St. Louis. For more information, there is a white paper in, or you can find it within BAM Share, as well as this teleconference webinar, if you will. And for more information, again, genesisknows.com or any of our teammates at BAM Risk Management. Thank you very much.